AT&T stock offers passive income investors a dividend yield of 8.25%. But is that dividend yield safe? That's what I'm going to answer in this short video. So let's get right into it. So the main thing I look for when I'm looking at a dividend and trying to answer if that dividend yield is safe is the comparison between earnings per share and dividends per share. And specifically, what I'm looking for are earnings per share that are consistently above dividends per share. That shows me the company is making sufficient earnings to pay a dividend, because dividends come after earnings. Earnings are needed to pay dividends. Without earnings, the company would run out of money and would not be able to pay dividends. So that's why I look for earnings as one of the most crucial metrics to determine if the dividend is safe. And looking at AT&T's earnings per share, it's a bit volatile. You can say the company did have very nice earnings during some years, surpassing $4 per share even, and when the dividend per share was around $2. But I see a lot of volatility, and only recently does the dividend per share actually go down, and even negative earnings in the last year, mainly due to some divestitures and one-time expenses that are not like repeatable in nature. Still, what I see from AT&T's earnings per share to dividends per share is concerning. Is concerning. The next thing I wanted to look at when I'm measuring if the dividends per share is sustainable or the dividend yield is sustainable is cash flow from operations to sales. Because sometimes companies can have expenses that bring down earnings per share, but these expenses are not cash expenses. These are things like write downs. They're a big non cash expense that brings down earnings dramatically, but it doesn't necessarily cost the company any cash. And so that's why I like to look at the cash flow from operations to sales. And in this metric, AT&T stock looks very healthy. A cash flow from operations to sales of 27% is very strong. And then in the last 5 years, it's been above 24% and rising. So this metric makes it look like AT&T's dividend is strong. So we have one metric that puts it into question, another one that shows it being very strong. And the final metric I will consider when answering if AT&T's dividend yield is safe is comparing its long-term debt to its cash balance. And looking at this metric, it's another alarming sign, perhaps the most alarming sign I've seen from AT&T's other metrics that I've looked at so far, and that is its massive $137 billion debt load. That's a lot of long-term debt, especially compared to the $2.8 billion in cash that the company has. Now, I will say on AT&T's behalf, looking at its strong cash flow from operations, the company generates enough cash to support this debt for now. Barring any unforeseen circumstance, the company can support this level of debt. It generates very strong cash flow that can support this debt. However, just the presence of such a massive load of debt puts the company at a greater degree of risk. Should there be some unforeseen circumstance that causes revenue to fall considerably, to cause a mass exodus of customers to rivals, that would leave it at a troubling position because it has this massive debt load. So, to answer the question, is AT&T's dividend yield safe? I'm going to have to say no, because of this massive long-term debt, right? I'm not saying the dividend is at any risk of being cut or paused imminently anytime in the near term. All I'm saying is that passive income investors, when looking out, let's say 5 to 10 years, AT&T's 8% dividend yield may not be the most long-lasting dividend yield. It may not be that long-lasting. All right, but that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.